Welcome to the Deep Dive, where we unpack complex information to give you the most important nuggets of knowledge.
Glad to be here.
Today, we're taking a deep dive into the recent financial results of American Express, ticker symbol AXP, for the second quarter of 2025.
Yep, the Q2 numbers just dropped.
Our goal today, to slice through all the chatter and give you the clearest picture of what's really going on with AXP. We'll explore everything from the headline earnings numbers to strategic shifts, the underlying financials, we'll look at the stocks chart, and the critical factors you should be watching.
And what's truly fascinating here, I think, is American Express's remarkably solid performance. They hit record revenue growth and a really robust adjusted earnings per share.
Record revenue, okay.
Yeah, and it's particularly noteworthy because they've reaffirmed their full-year guidance for 2025. And they did this even with what they describe as an uncertain global macroeconomic environment.
Which is saying something right now.
Exactly. This kind of confidence really underscores the resilience of their premium customer base, which, tends to be much more stable financially. What this ultimately suggests for you, the listener, is maybe a perceived lower risk and higher reliability in AXP's financial projections compared to many other companies out there.
Okay, that definitely sets the stage. We've got a lot of compelling details straight from their Q2 2025 earnings report. Let's dig in.
Yeah.
So after all the anticipation, what were the numbers that really grabbed the market's attention in AXP's Q2 report? Did they live up to the hype?
Well, I'd say they absolutely did. American Express announced record revenues hitting $17.9 billion in Q2 2025.
$17.9 billion.
Yeah, and that's a significant 9% increase year over year. Now, for the reported diluted EPS, it initially looks like a slight 2% decrease at $4.08 compared to $4.15 in Q2 2024.
Okay, slight decrease.
But here's where it gets really interesting for anyone analyzing the company. That Q2 2024 number included a one-time gain. It was $0.66 per share from the sale of Accertify.
Ah, the Accertify sale, right.
Yeah. So if we adjust for that, the adjusted EPS for Q2 2025 is $4.08, which actually represents a robust 17% increase from the adjusted Q2 2024 EPS of $3.49.
17% increase adjusted.
Yep. This adjusted metric is absolutely key for understanding the underlying operational growth. It shows the core business is performing very well.
Wow. That adjustment makes a huge difference in how you read the numbers. So looking past that, what does this strong performance mean for their future outlook?
Well, the company has firmly reaffirmed its full-year 2025 guidance.
They're sticking with it?
Yep. Projecting revenue growth of 8% to 10% and an EPS range of $15 to $15.50. This stability in guidance, especially, when the economic winds are shifting, suggests strong confidence from management.
Confidence is definitely the word.
And we also saw card member spending hit a new quarterly high, up 7% year over year.
Spending's up too.
If you break that down, spending on goods and services grew 8%, or 7% if you adjust for currency fluctuations, and travel and entertainment spending increased 6%, or 5% adjusted for FX.
Okay, so Teeny is still growing, but maybe a bit slower.
A little bit. While there was a modest slowdown in airline and lodging spending, the restaurant category, interestingly, maintained very strong growth.
Restaurants are holding strong.
Seems like it. So maybe fewer people are flying first class to Bali, but they're still happy to drop some serious cash at their favorite local bistro.
That sounds about right for the current economic moves, doesn't it?
It definitely tracks with what I'm seeing.
Beyond those impressive numbers, were there any strategic moves or product announcements that caught your attention?
Absolutely. AXP announced important updates for their U.S. consumer and business platinum cards.
The platinum cards, okay.
Those are set to launch in the fall. And that's crucial for maintaining their leadership in the premium segment,
Got to keep those perks fresh.
Right. And in a forward-looking move, they also launched the new Coinbase One card on the American Express network.
Coinbase. So dipping into crypto.
Exactly. Signaling an entry into the cryptocurrency space, which is, well, it's a bold play. Their commitment to customer experience was also recognized. J.D. Power ranked their mobile app and website experience #1 in customer satisfaction.
That's always good validation.
Plus, they were ranked #4 in Great Place to Work as best companies to work for in U.S. 2025, which highlights a strong internal culture, something often overlooked but I think important for long-term success.
That's great context, showing a healthy operational picture. But sometimes it's the external, less predictable events that truly move the stock needle. What are those bigger factors we need to keep an eye on? Perhaps those less tied to quarterly operations?
This is an important question, yeah, as several recent developments could certainly influence market perception. First, AXP reclassified $1.6 billion of Amazon co-brand loans to held for sale, or HFS.
Held for sale, meaning they plan to sell them off.
Essentially, yes. They intend to sell these loans. This move freed up $144 million from credit loss reserves, which positively impacted their provisions this quarter.
Okay, little boost there.
They also completed the acquisition of Center AD Corp back on April 16th, 2025, recognizing about $590 million in goodwill in their commercial services segment. And as we discussed, that Accertify sale gain from Q2 2024 had a significant one-time impact on the reported EPS comparison.
Right, always look at the adjusted number.
Always remember to look at that adjusted metric for the true operational insights.
So we've got some positive financial adjustments and strategic acquisitions. What about potential headwinds? Any risks looming?
Indeed, and this is probably the most significant point. The most tangible risks American Express is facing are the antitrust litigations.
Ah, the legal battles.
Yes. They are vigorously defending several lawsuits, including Pizza Hazel, Inc., Five Star General Store, and a big class action, Anthony Oliver et al. V. American Express Company. And that one has a trial scheduled for July 2025, so very soon.
This month. What could
Yeah.
happen there?
Well, an adverse outcome here could force AXP to alter its business model or, face substantial fines, which would directly impact profitability. While another case, B&R Supermarket, was settled in principle, and that wasn't directly against AXP, it does hint at maybe an industry disposition towards resolving these disputes, potentially setting a precedent.
So that trial is a major event risk.
Absolutely. And finally, AXP is also under continuous IRS examination for 2017 and 2018. They received a proposed adjustment for $185 million in federal taxes and $50 million in penalties.
Okay, totaling.
Totaling $235 million, which they plan to contest vigorously.
$235 million. Is that significant for them?
Well, AXP views it as not material, but, this sum could impact net income and cash flow if their challenge is unsuccessful, so it's definitely a factor for you to consider.
Right, another uncertainty. Okay, now let's zoom in on the core financials, the revenue streams and the profit picture. How exactly did American Express generate this impressive revenue growth? And what does the profit analysis tell us about their financial health?
Okay, so if we connect this to the bigger picture, AXP's total net revenue, which includes interest expense, was very strong. It hit $17.856 billion in Q2 2025.
That's the 9% increase number.
Exactly, a 9% increase year over year. And for the first 6 months, total revenues were $34.823 billion, up 8%. This growth was really propelled by several key components.
Break it down for us.
Sure. First, discount revenue, which is basically what they earn from merchants every time you swipe your card. That grew a solid 6% in the quarter, directly linked to that increased card member spending we mentioned.
Makes sense. More spending, more discount revenue.
Then you have net card fees. These saw significant 20% growth in the quarter.
20%, that's huge.
It is. And it's driven by high levels of new card acquisitions, strong card member retention, and people upgrading their cards. Think of it as more people joining, staying, and opting for those richer card benefits. The average fees per card, for example, increased a notable 16% to $117.
So they're succeeding in getting people into those higher fee cards.
Precisely. Then there's net interest income. That increased 12% in the quarter. This is primarily from growth in revolving loan balances, people carrying balances, and increased usage of lending features like pay over time.
Okay, so the lending side is growing too.
Yes. And finally, service fees and other income grew 8%. This benefits from things like cross-border spending, currency exchange, network partnerships, loyalty coalition fees, and even some income from a partial card portfolio sale. What's important is this broad-based growth. It was observed across all operating segments, even after adjusting for currency fluctuations, which truly indicates underlying operational strength.
The revenue streams certainly appear strong, diversified too. But looking closer, are there any areas that might be less sustainable or face increasing competitive pressure in the coming quarters?
That's a fair question. I mean, while it's robust across the board right now, the continued outperformance of, say, the fee-based products and the cross-border spending will be important to monitor. If global travel really cools off or if premium card demand softens significantly, those areas could face pressure.
Right.
However, the diversification across multiple revenue lines and their focus on those high-value customers provides a pretty strong buffer, I think.
Okay, so diversification helps. Now, what about overall profitability? You mentioned the adjusted EPS growth was strong.
Right. So the consolidated net income for Q2 2025 was $2.885 billion. That was actually a 4% decrease from Q2 2024, and the reported diluted EPS followed, decreasing 2% to $4.08.
But again, the adjustment.
Exactly. Let's remember that Accertify sale gain. Excluding that $1.66 per share from Q2 2024, the adjusted EPS for Q2 2025, $4.08, actually represents that 17% increase over the adjusted Q2 2024 EPS of $3.49. This adjusted metric truly provides, a more accurate image of AXP's underlying operational growth. And as you can see, it's robust, driven by that strong revenue growth and disciplined expense management, even with an increase in credit loss provisions.
And what about broader profitability metrics like return on equity, ROE? I noticed that dipped a bit. Should that be a concern?
Yeah, that dip in return on average equity to 36.3% for Q2 2025, down from 41.4% in Q2 2024. It isn't necessarily a red flag. It looks more like a strategic move.
How so?
Well, AXP seems to be deliberately fortifying its capital base and making long-term investments. It signals a focus on sustainable growth over maybe maximizing short-term ROE boosts. For you, the listener, this suggests they're playing the long game, prioritizing financial stability.
Okay, building resilience.
Exactly. They maintain their Common Equity Tier 1, or CET1, ratio at 10.6%. That's right, within their 10-11% target range.
And CET1 is a key measure of bank strength, right?
It's a core measure of a bank's financial strength and its ability to absorb losses. And crucially, the Federal Reserve's annual stress test, CCIR, the Comprehensive Capital Analysis and Review.
This stress test.
AXP notably showed the lowest projected credit card losses and the highest return on assets among its peers in that test. That's a significant thumbs up for their risk management.
That's impressive validation.
It really is. And they also returned a substantial $2.0 billion in capital to shareholders in the quarter.
$2 billion back to shareholders. How?
Primarily through significant share repurchases, about $1.4 billion worth, and consistent dividends, around $0.6 billion. This indicates, I think, proactive and prudent balance sheet management, prioritizing long-term sustainability while still rewarding shareholders.
That's a great clarification on the ROE diff. Now let's dive deeper into what's driving the card member spending and how American Express is managing its credit risk. That's so crucial in the financial sector. After that, we'll turn our attention to the AXP stock chart itself.
Sounds good. So the total billed business, which represents all that card member spending, grew a strong 11% year over year. Digging into that, spending on goods and services grew 8%, or 7% FX adjusted, and travel and entertainment spending increased 6%, or 5% FX adjusted.
Okay, still solid growth across the board.
Yeah, and what's fascinating here, as we touched on, is that while airline and lodging spending saw that modest slowdown, restaurants, which is actually their largest T&E category, continued to show very strong growth.
People got to eat out, I guess. And who's doing all this spending? Are they still acquiring a lot of new customers, or is it more about existing card members spending more?
It's a mix, but there is definitely a strategic shift visible. The growth was distributed across AXP's customer segments, with U.S. consumer services growing 7%, but this was significantly fueled by Millennial and Gen Z card members.
The younger demographic focus.
Exactly. They represented an impressive 63% of new global consumer accounts and 71% of new global fee product accounts.
71% of new fee accounts.
Yeah, this truly highlights a strategic focus on future high-value customers. American Express acquired 3.1 million new proprietary cards in Q2 2025. Now, this is slightly lower than the 3.3 million acquired in Q2 2024.
So fewer new cards overall.
Slightly fewer, but the company emphasizes they're prioritizing quality over quantity. They're focusing on customers who will drive higher long-term value and profitability, particularly those opting for those fee-based products.
Quality, not just quantity. Makes sense for their brand.
Right. And loans and card member receivables also increased 7% year over year, which aligns nicely with that billed business growth.
What about the credit performance then? In this uncertain macroeconomic environment, this is always a key area to monitor. Are we seeing any cracks?
Well, American Express demonstrated solid credit performance, which is frankly a testament to their prudent approach and maybe their customer base. Though provisions for credit losses did increase, they went up to $1.405 billion in Q2 2025 from $1.268 billion in Q2 2024.
Provisions are up. Why?
This increase was primarily due to a greater net reserve build, meaning they set aside more money for potential future losses and also higher net write-offs. But those higher write-offs were mainly driven by the growth in their overall loan portfolio. More loans mean potentially more write-offs numerically.
Okay, so driven by growth, not necessarily worsening quality.
Exactly. The key credit quality metrics remain stable or even improve slightly. The net write-off rate, looking at principal only, slightly decreased to 2.0% from 2.1% a year ago.
Decreased. That's good.
Yeah, and the 30-plus day delinquency rate remains stable at 1.3%. AXP maintains these indicators are best in class, which compared to peers, they generally are.
Best-in-class metrics still.
Right. This indicates a proactive and conservative management approach, building cushions for potential future losses, which is a strong positive for their long-term stability. And also remember that reclassification of the $1.6 billion in Amazon co-brand loans to held for sale.
Yeah, you mentioned that freed up reserves.
Right. It released $144 million from associated credit reserves, which impacted these provisions positively this quarter. So the underlying build was actually a bit higher.
Got it. That proactive approach to credit losses sounds reassuring. But with all this growth and strategic investment, how is the company managing its expenses? Is spending spiraling, or are they keeping a tight rein?
That's always a critical balance, isn't it? And it looks like they're managing it effectively. Consolidated expenses rose 14% year over year, reaching $12.9 billion in Q2 2025.
14% increase in expenses. That sounds like a lot.
It does, but you have to break it down. The increase was primarily driven by variable customer engagement costs, things like rewards. And these costs grew slightly faster than revenues, which they attribute to a deliberate shift towards those premium offerings and enhanced value propositions. More perks cost more money.
Okay, so costs tied to generating that revenue and keeping premium customers happy.
Precisely. For example, rewards expenses increased 9%, and business development expenses increased 11%. Marketing expenses also increased 5%, reflecting ongoing investments in acquiring those high-spending, high-quality customers we just talked about.
Investing in growth.
Right. Salaries and employee benefits rose 10% due to higher compensation. And additionally, there's a category called Other Net Expenses, which showed a significant 62% increase.
52%. What's in there?
That was largely due to the comparison effect of the Accertify sale gain back in Q2 2024, remember. That gain reduced last year's expenses by a one-time factor, making this year's comparison look larger.
Ah, that comparison effect again.
Yeah, and also somewhat higher professional services costs in Q2 2025. But what's notable is that operating expenses, when excluding the impact of the Accertify gain, grew pretty much in line with revenue. This indicates investments in risk management capabilities and technology to support continuous business growth. It's not just spending, it's investing.
That makes sense. It's about smart spending for future growth. Okay, let's pivot now and talk about the stock itself. As of today, July 18, 2025, how is AXP looking from a technical analysis perspective? What does the chart tell us?
Okay, looking at the chart, the technical analysis of American Express reveals a strong and consistent long-term bullish trend. At its current trading price, around $308.57, it's showing a slight drop today. About 2.15%, the action is still comfortably above its key moving averages.
Okay, above the key averages, which ones are important here?
Well, the 20-day exponential moving average, EMA, that's a short-term indicator. The price is slightly below it right now, suggesting maybe some short-term consolidation after hitting recent highs. But critically, it remains above the longer-term averages, keeping the short-term uptrend intact for now.
So, a little pause maybe, but trend still up short term. What about medium term?
For the medium term, we look at the 50-day simple moving average, SMA. That's clearly rising, and it's well above the 200-day SMA, which confirms a solid medium-term uptrend. This 50-day SMA could act as an important dynamic support level if we see a deeper correction.
And the big one, the long-term trend.
Most crucially, yes, the 200-day simple moving average, SMA. This represents the long-term trend, and it's significantly below the current price. It also shows a steep upward slope. This really paints a picture of a robust, long-term bullish trend. A break below that 200-day SMA would be a pretty significant signal of a long-term trend change.
So the charts are flashing strength overall, which is good to hear. Are there any specific resistance or support levels we should be aware of if we're, looking at the stock chart?
Yes, definitely. The recent high up around $311, $312, that acts as immediate resistance. Breaking above that could signal the next leg up.
Okay, resistance near the recent highs. Support.
The 20-day EMA near the current price is a dynamic short-term support or resistance, depending on which way it breaks from here. Below that, the 50-day SMA, which is approximately between $290 $295 right now, that's the next key support level to watch.
280 to 295. And the long-term support.
That would be the 200-day SMA, currently down in the $250, $260 range.
Yeah.
That's a very strong long-term support level, crucial for the continuation of the overall uptrend.
Good levels to keep in mind.
Absolutely. But it's always important to remember technical analysis is really a complementary tool. Fundamental events like the earnings we just discussed and ongoing corporate news like those litigations can have a significant impact and definitely override short-term technical signals.
Right, need the full picture.
A comprehensive evaluation always requires combining both the technicals and the fundamentals.
We've covered a lot today about American Express's second quarter results. Let's quickly recap the most important takeaways from this deep dive.
Sure. I think the main points are that American Express has shown really exceptional performance in Q2 2025. You've got impressive revenue and, importantly, adjusted EPS growth. It highlights the resilience of its premium business model and continuing strong demand.
And the credit quality.
Despite an increase in the provisions set aside for credit losses, their actual credit quality metrics remain robust and, as they say, best in class. This underscores prudent risk management and a strong capital position backed by those stress test results.
Okay, strong performance, good credit.
Yeah, and they're also strategically investing in key growth areas like technology and those younger demographics, maintaining a strong capital position, and consistently returning capital to shareholders.
Yeah.
And from a technical standpoint, AXP maintains that strong long-term bullish trend on the chart.
So, for you, the listener, what does this all mean looking ahead? What's the short-term and long-term outlook for AXP, and what should you really keep an eye on?
Okay, so in the short term, AXP's stock might experience some volatility. I think that's fair to say. It's mainly due to those pending antitrust litigations, especially the Anthony Oliver trial set for this month, July 2025, and also that ongoing IRS dispute.
Those legal overhangs.
Exactly. These are uncertainties the market will be pricing in, and legal outcomes can be unpredictable, as we know. However, the reaffirmed full-year guidance and the underlying operational strength we discussed could help mitigate any significant drops, provide some support.
Longer term.
For the long term, AXP's business model focused on that affluent premium customer, combined with product innovation like the updated Platinum cards and that new Coinbase One card. It seems to position it well for sustainable growth. Their strategic investments in key demographics like millennials and Gen Z are, I think, fundamental for future customer and revenue growth down the line.
This really raises an important question for your own continued research and understanding then. How will American Express continue to navigate these dual pressures? You've got the uncertain macroeconomic environment on one hand and these ongoing regulatory and legal challenges on the other, while still trying to deliver strong growth from its premium customer base.
Exactly. That's the key question, isn't it? For you, whether you're an investor or just a curious mind following the company, it's crucial to monitor several key factors in the coming quarters. First, the broader macroeconomic environment and its potential impact on card member spending and credit quality. Does that premium resilience hold up?
Right.
Second, the precise outcomes of those significant litigations. That Anthony Oliver trial is huge. Also, any new regulatory developments in the payment space, how AXP maintains its competitive edge against rivals, both traditional and fintech.
Competition is always fierce.
Always. And finally, just keeping an eye on the detailed trends in consumer spending, especially within those premium segments, and the overall quality of their loan portfolio, those delinquency and write-off rates.
Lots to watch. We hope this deep dive into American Express has given you a clearer, more informed perspective on their recent performance and future trajectory.
Yeah, hopefully that helps cut through some of the noise.
Thank you for joining us for this deep dive. Until next time, keep learning and keep digging deeper.